welcome to the podcast, everybody. Thank you for joining me. Appreciate it. Well, we're doing this in the middle of the day. Towards the end of the day, it closes. It'll close here in about an hour and a half, and it's been pretty much a quiet session after yesterday's shellacking, so thought I'd go ahead and get this out to you ASAP. And we're going to touch on the stock market. We're going to talk about what may be causing this sell-off this quickly. And then we'll also discuss the iWatch, and we'll touch on gold as well, maybe even oil, and maybe even the VIX, and maybe even interest rates. I don't know. We'll see how much time we have. All right, Dow Jones is right now up about 25 to 30 points and been pretty stagnant all day. Came out with in the morning, little pop, but not the type of enthusiasm that you'd expect after a nasty day yesterday when the Dow was down 330 points or so. And we'll take a look at that. Before we get started, don't forget eggerscapital.com is the website. We're on Twitter. Don't forget to check out our radio show, which airs every Saturday morning from 7 to 8 a.m. You can hear it live streaming on the Answer AM 930 in San Antonio, or you can, of course, listen to the archives. And if you sign up on the website, then you don't have to you can listen to it whenever you want to. But we do it on Saturday mornings. That's when the show airs. So anyways, Dow Jones up about 20 right now. You can see this picture here. We we're in this consolidation really starting in December, moving on until early February, and we broke out to the upside. And so far, it's been the fake out breakout. Had you bought that on that breakout, you would be underwater right now. This is the breakout I'm talking about right here. I said it's going up to the moon, and of course, it didn't go up to the moon. It actually went back down. So, but what is this telling us? Why is this happening, and where do we suspect that we will see some buying at some point? People are blaming it on the dollar, and I think it's interesting when you take a look at the dollar, and I'll pull it up here real quickly for you. This is the picture that people are saying, hey, this is why the stock market is selling off. Well, I don't remember the stock market selling off starting here in August when it started to go up. So why is it all of a sudden, is it a tipping point? Maybe it is. As the euro and the dollar approach parity, 1-to-1 is in euros falling, obviously. They're doing this quantitative easing. That is causing the euro to fall. It's causing those interest rates in Europe to fall. And but look, is it a tipping point? Maybe, but I'm not going to say that this sell-off is because the dollar's rising when it's been rising, and we haven't really seen that. So I'm not necessarily buying that. I think what's really happening, we'll switch over to the S&P 500, is simply that things got a little stretched and we're at the top end of the range. It looks a little different picture than the Dow. I think that we've actually been short in our aggressive strategy for, a week or two now, and it's not a big position at all. We're definitely not net short by any means, but we're simply have a short position on. We're also short the yen as well. So we've got some things that are kind of moving opposite the market right now, which is nice on a day like yesterday. In our longer term portfolios, in our more moderate ones, we're not making major changes yet. We have a little bit of cash in some of those and not making major changes because this is just vibration, guys. Remember, when you see a 300-point down day on the Dow Jones, that in percentage terms is much different than a few years ago. So don't be alarmed by that. It was a bad day yesterday, but it wasn't even a 90% down day, they call it, where 90% of the volume's down, 90% of the points lost, 90% of the stocks down. We didn't even have that. But it was a bad day, but we're just ebbing and flowing here. And so now we're sitting at the 100-day moving average. We've broken through the 50. Will we come back to the 200? Now, coincidentally or not, here we are, the red line's the 200-day moving average, sitting about at this 2,000 mark on the S&P. So that would be the first line that you may want to say, hey, if I'm short, I start covering. If I've been wanting to buy, I put a buy in there. In fact, if you don't have any positions you're looking to buy, that's not a bad spot to do so. If you even want to put a stop slightly below that, you can do that. But that is the first place that I would start looking to add. We didn't get this flush down and this reversal. Remember, going back to October, that was not officially a 10% correction, but real close to it. When we got down here, we saw the big reversal. See this big tail here means that we opened It started to fall. We came back and we closed right up here. So this was an intraday low, kind of a reversal. The next day went a little lower, had another tail on it, and that was it, off to the races. So those are typically what bottoms look like in terms of the velocity of the down, and then just the quick turnaround in the middle of the day. So for us to finish on the lows yesterday, coming today with a mediocre day, at least as I'm recording this, these aren't the things necessarily bottoms are made of. You want to see that flush out. We haven't seen that just yet. So again, why is it happening? I think it's simply happening because we do know earnings have slowed down a little bit. Okay, we know that the earnings estimates going forward are slowing down, and we know over the long run, profits of companies should be correlated to the stock market. The other thing that's been driving the stock market is the Federal Reserve, right? Keeping interest rates extremely low. They've been saying, hey, we're going to end quantitative easing, and you saw earlier I had this line drawn on right about, back in October here. This is when they ended quantitative easing right here. So look, they ended it back here in October, and we got this immediate volatility. We've had volatility ever since, and that will be the time. If we look back and this market breaks down, that will be the line in the sand that will say, hey, that's when things started to change, was in October, not now here in 2015. But so far, you see advanced decline lines are still improving, and those typically have a 4 to 6 month lead time on a bear market. So, I think it's just a mixed bag right now. I don't think you make drastic moves one way or the other. If you get too bearish, you can see this market snap right back like it did in October. So be careful. What we're talking about in the short run is, can we get a little more out of this on the downside before we have a rally? Now, there are some things getting oversold already, but they're not as oversold as we would like them. So having said that, why is it happening? We're getting the earnings estimates going down for the stock market. We're getting QEs gone, and now the Fed may or may not raise rates. And we get these strong jobs reports, and there's a pity party, right? Where Wall Street says, "Bummer, we don't want the Fed to raise rates." And so when you got that strong jobs number on Friday, it spooked the stock market. And I'm going to write an article about this, but that is a worst case scenario for investors, is that the Fed is tightening, interest rates are going up, at the same time that the stock market goes down, causes the bond market to go down, so stocks and bonds together fall. We've seen stocks go down, bonds go up, and conversely, the opposite happens. That could be a worst case scenario, that stocks and bonds together fall, because there's a lot of people in this country who only own stocks and bonds, and they try to mix the ratio up. But if the whole thing's going down, it doesn't insulate you. So why is it going down? Because there's more people selling right now. Okay, that's the bottom line reason. I don't see any clear evidence of, yes, the strong dollar is going to hurt some international companies, but it's been going up for quite a while. And, you've got comments from some people saying, look, the dollar is going to keep going up. It's certainly getting overbought and due for a reversal. But, look, bottom line is, yes, it's put a damper on things the last few months, but I don't think yesterday's sell-off was simply because of the dollar. But if we do look at things like the euro, if you own the euro, this is what your portfolio looks like right here on the euro, is that you're getting this, just completely falling apart to where it's getting to almost parity here. And so that's a pretty ugly trade. If you're long, or if you're short the euro, in other words, that could be crowded. You might want to start taking some profits. We are short the yen. And again, this isn't our aggressive strategy, but you can see here, broke down, kind of consolidated for a while, and now it's breaking down again. So as this falls, that is good for our position being short the yen. And again, that's just a trade. That's not a long-term position. It's going to be something that could reverse at some point as well, but it's something that we are happy that we're in, and it's something that moves opposite of the stock market, or has been the last few days. So we like that as well. All right, I wanted to talk about gold real quick. So we know that gold, has been moving as the dollar's been going up the last few days. Gold has been getting hurt, and it's continued to get hurt. And you can see this, it does appear that it could be reaching a technical exhaustion point where we could see gold start to rally. So watch for gold for a trade. We don't own any right now, but watch for this over the next few days. If you do see the dollar, people start to take profits in the dollar, watch to see gold start to turn the corner, and could it make a run? Again, as a trade, sitting here at 110, going up to 120, 122, that's a 10% move. It's not a bad move, and it doesn't change this pattern that we've been in, where it goes from the top to the bottom to the top to the bottom. it could just go to the top, but that could make you some good money. So watch gold, and if you look at it down here, and then again, you're trading it, want to put a stop, that's fine. So watch gold. Of course, if you like gold, that means you like, gold miners, which is right here looking ugly, but they are actually up on the day, up about 3%. So again, you want to take a stab at those. There's your line in the sand right there. If it breaks that, you get stopped out. Those are some short-term trades. That's not a fundamental move. I don't know what would cause them to go up other than the fact that they're oversold. So just looking for trading ideas in this market. I think if you can do those types of trades, shorting the yen, adding some short to the stock market, those types of things, then it frees you up to own stocks that you don't want to sell. If these are good fundamental companies that you own, and we have some that we like that we continue to keep through this market, even though it's getting a little more volatile. Let's go to Apple. I've been writing some stuff lately about Apple, how we actually lightened up on it. We own it in our dividend strategy. We actually sold a little bit of it back in here, and it's a good move so far. It's not a huge move down, but again, you take this kind of triangle into this wedge pattern here. We could see the first support would be around 120 for Apple, which is at 123, not a big move. A better entry point would be at 112, and you're not there. Apple's not getting a lot of love after the iWatch came out the other day. Looks like a great product. Not sure if I'm going to buy one. Seems to be expensive, but yeah, cool product. But this isn't anything anybody didn't know. So everything's hitting on all cylinders for Apple. They're getting all the upgrades in the world. But that's exactly what was happening in 2012 when the stock fell 50%. So we go back to this notion of over-owned versus expensive. Apple's not an expensive stock. It's a great dividend stock. It's a great company. Love it, love it, love it. But do I want to buy more of it sitting at $135 a share? The answer was no. So we just simply took some profits on it and shaved it down a little bit, and we will look to re-enter that position at some point. So we do own it. I want to be clear with that. We do own it. We just don't own as much of it. So if this comes down to here and can hold, and maybe the 200-day moving average goes up like this, and we're sitting around 115 to 110, absolutely, it's a buy at that point, given everything that they're doing right now. And don't forget, this is a company that could do a special dividend at any moment. Remember, Microsoft did that back, 10, 11 years ago. Just to, who's to say they couldn't say we're going to give out $10 a share to everybody? And they could do that very easily. So that's something that Apple has as a dividend stock. They can continue to raise it, but do I want to own it? Right now, and am I as enthusiastic as I was a few months ago? No. I think I may have mentioned, you're hearing it, Apple. I mean, nobody can find anything wrong with it, and that's my problem with it. So I'm just putting on a little bit of a contrarian hat. But if it holds at 120 and then starts to take back off again, which it very well could do, so be it. So be it. But I still own it. But I would love to get it down more like the 115, 110 area, which would be a nice sell-off to take advantage of. So still a great company doing some pretty amazing things. Let's take a look at the VIX real quick, volatility index. Just kind of jumping around here. Again, we're not at this point where it's an easy buy for the stock market. I'd love to see this VIX pop a little bit more, get a little more fear. Then we can go buy like these particular areas here. So that would be on the VIX. We take a look at oil, and this is through yesterday. Oil, it's stabilizing. That's all you can say. This is the longest it's moved this sideways for a while, but it's going to continue to be volatile. It's going to bounce around. If it can bounce around between 50 and 45, that's okay. But I think what we need to see, at least the bulls need to see, is they need to see somewhere in this area, $60 to $65 is where a lot of people would be happy. Certainly 80, 85, a lot of people would be happy. Again, if you own energy, if you're just a consumer of oil and gasoline, then of course you want this thing to keep falling. But as I've said before, be careful what you wish for. If the oil keeps falling and goes into the 30s, we may have bigger issues, and your 401k getting cut in half may be a bigger issue than you saving a few pennies, a few dollars on gasoline. So watch that. But I do think that from an investment standpoint, there are investments. I got a request yesterday to look at Exxon, and let me show you that real quick. I think Exxon is good right now at $85. I think for an investment. Remember, it's already fallen from 105 down to 85, so almost 20% drop. If it gets down to around, I think sub 80 is more of a screaming buy. Remember, this is a company, 3.25% dividend, just a cheap company. And remember, these companies, Exxon, Chevron, Conoco, we actually own Conoco. COP is the one we own. Don't forget that these companies are, dominant companies that literally want to take advantage of the companies that are struggling. And you see Conoco down here. We own it in our dividend portfolio. It pays a really fat dividend. 4.7% is the dividend on that one. And, and a good rule of thumb, don't always jump to high dividend paying stocks. That's not what I'm saying. But I do like, of the ones, I like Conoco the best. You can see it's got some good support here, but it's more of an investment at this point. And if it certainly breaks this area here and can take off, then we've got something nice. But, when oil drops this much and these stocks drop this much, these are long-term investments. If you're looking for a trade, you look for the weaker stocks, the ones that were hit the hardest, the highly leveraged ones, because they're going to bounce the most. But if you're looking for an investment, to me, you look at the integrateds. If you want to step down into, the E&P companies, I think EOG is a company that kind of a leader in that area. And again, remember, this EOG is still sitting down here about 27% off its high. So, that would be a company I'd look for from a investment standpoint. From a trading standpoint, they're going to move like oil. So if you think oil's bottomed, they're all fine. If you think oil's going to keep going down, they're not. So I've got some, and we're just holding pattern right now. And that's where we are on that. Isn't that something like what Forrest Gump said? That's all I got to say about that. Interest rates. You can see Treasury yields have jumped up quite a bit. We got down to a low of 1.6 or so, and we recently jumped up to 2.24. We're still close to the high here. A lot of people looking at this chart saying, okay, well, we're still in a downtrend, and that could be the case. But again, it's going to be pretty hard to keep rates down if we keep getting those jobs reports like they did. And if we get some better economic news, you could see rates go on back up. But right now, when the rest of the world's rates are crumbling, it's no shock that we're sitting here at 2.1%. In fact, 2.1% looks pretty good when Germany is paying 0.3% on their 10-year treasury, So it's a relative thing. You have to remember that rates are relatively high still in the U.S. compared to the rest of the world. So that's where we are. Don't forget, too, be careful which market you're looking at. For example, today, mid-caps are actually up quite a bit. Small caps are up a little more, a little less than that. It's the Dow Jones that's not doing that well. So it just depends on the day. Emerging markets doing very well today. Again, for the longer term, we like the foreign markets, and we're not big into them right now, but we have a piece of it, and we would certainly add more because from a relative standpoint, the U.S. is very expensive compared to some of those places right now. Do you know Russia has a P/E ratio of 3? Now, it's not to say 3.8. It's not to say it couldn't go down to 2, but it's getting pretty cheap in some of these areas over there. And be careful. But my point is, I think the emerging markets and some of the foreign areas, from a value standpoint, look much more compelling than the U.S. right now. All right, crammed in a lot of stuff in just under 20 minutes. Enjoy the rest of your day, and keep the questions coming. We will talk to you soon.